The market's all-time high is not what it seems. It's a big fake out. Now, if you've been paying attention to the markets at all in 2021, you already know that we pretty much have every market at its all-time high levels, but it may not be what it seems. While you might feel like you've made a lot of money, have you really become more wealthy? Well, the bad news is unless you're looking at accurate data, which is probably not what you're looking at, then you might not have done as well as you think you have. So in this video, I'm gonna break down what most people see and think. I'm gonna show you how the mainstream data that you're using to measure your returns is completely manipulated and wrong. I'm gonna show you how to see through this fake data and see what's really going on. And of course, most importantly, I wanna show you what to expect in 2022 and how to be prepared to prosper. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss and I make these videos to change the way you think about money because almost everything that you have learned is wrong. Now today, I'm gonna show you that almost everything that you're looking at is wrong because the data that you're using to measure everything is completely manipulated. It's completely broken. So your returns are not what you think they are. And of course, once you figure this out, you're gonna know how to look at things differently. Most importantly, I'm gonna show you what to expect next year, 2022. So you can prosper. Now, real quickly before we jump into the video, I do want to let you know that I am having a live presentation where I am going to break all of this down next week. I'm going to show you the things that I'm doing with my portfolio to get ready for 2022, to finish 2021 strong and to make 2022 the best year. It's longer than I can put into a short YouTube video. So join me live. I'm going to show you all the things that I'm doing that you should be doing to finish this year, make next year the best year ever, to have that foundation. Of course, live Q&A, answer all your questions. Make sure you are set up. This is one little piece of it, but make sure there's a link down below, so don't miss it. Join me. All right, let's jump in, and I want to show you the data that you're looking at is wrong, and I'm gonna show you what to look at. All right, now the first thing is we're looking at markets, right? So we have the stock indexes, we have the S&P 500 and the NASDAQ and on and on and on. If we're looking at the NASDAQ stock exchange, the QQQ, from 2009 to today, so we're looking at 2009 because that was after the great financial crash. And so from 2009 till today, you can see it almost looks like it has gone straight up, straight vertical. As a matter of fact, it's gone up over 1,300% returns since 2009, which is amazing, right? I mean, congratulations if you've been in the NASDAQ that long, you've done great. But however, what you see is not what you get, all right? What you see is not what you get. Now, before I go all the way through this, I do wanna let you know that I have got this video from one of my good friends, Preston Pish. You should give him a follow on Twitter. He's the one that put this together, so I'm presenting some of the data that he put together. Preston Pish, at Preston Pish. Find him on Twitter if you want to get more good data like this. But as I just said, so if you're looking at your returns, the NASDAQ, the S&P 500, whatever, this is kind of what you'd see, just straight growth, all right? So that looks good, right? And if we look at it globally, that was the United States. If we look at it globally, we'll see much of the same thing. So if we look at the global stock indexes, as we'll use like the Russell 3000 ETF to do this, we can see very similar things. Since 2009, India has gone up the most, 638%. But most of these indexes, China has gone up the least. We're only up about 75% right here. But you can see almost all of the countries since 2009, since the great financial crash, have been going up. Some of them in different amounts. So you hear about investing in emerging markets and stuff like that. And so these are some of the returns. But again, since 2009, it's all gone up. That all looks really good, right? So, you know, it's not timing the market, it's time in the market. If you would have just sat in the market since 2009, you would have made all this money, etc. Right? Well, maybe not. Now, in order to see this data a little bit more clearly, what we want to do, because on the other chart, it was all the major stock indexes around the world, but it was all in different currencies. So the first thing that we want to do to get the accurate data, to get the real picture, is we want to convert all of those other currencies into US dollars. So here is now the same chart, but now we've put all the currencies into US dollars, so we have a much better picture. And what we can see here is that now the USA has been the leader, up almost 500%. India is next, about 400%. China and Hong Kong are down in the 80s. And so when we put it in US dollars, again, when we change the data, we have to change the data. This is the big thing. Now I'm about to show you some other stuff, but we start to get a much more accurate picture. All right, so let's keep going. Now, What about the dollar? So we just measured all the stock indexes of the world in US dollars. So this is the key piece right here. So you have to know that everything in life is a trade-off. If I want to buy a hamburger, I'm trading dollars for the hamburger. If I want to buy Tesla stock, I'm trading my dollars for Tesla stock, trading dollars for my house, trading dollars for Bitcoin, whatever it is. But the dollar makes up half of every transaction that we do, and so it's the measuring stick. So we just measured the NASDAQ in US dollars. We just measured all the stock indexes of the world in US dollars. So the US dollar is our measuring stick. Does that make sense so far? That's our measuring stick. So we need to look at the measuring stick. This is where the data starts to change. So is the dollar itself changing? Is the measuring stick a foot, and is it still a foot, or has it gone from a foot to 6 inches? Is the measuring stick still the same? So is the dollar changing? Well, we can just look at the M2 money supply, the currency supply. And so if we look at the same time chart since 2009, we can see that it has gone up. This would be a flat line. So of course we've been going up, 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 of course, till March of 2020. Most of you guys have probably seen me use this chart extensively. Let me make it a little bit bigger for you guys in the back that can't see it as good. So since March of 2020, we have basically gone up in a straight line. And so the money supply, the US dollar supply, which we're using as our measuring stick, has been changing. All right, now this means as it's growing, as they're growing the money supply, what they're really doing is they're debasing it. They're debasing the money supply, or they're devaluing it. So the more dollars that come into existence, the less all the existing dollars are worth less, or becoming worthless, right? You get that. So that's since 2009. So now that we know what's happening with our measuring stick, let's go back and look at those same markets again. So if we take, again, the major stock indexes, but this time we adjust it for the new money supply, we get a much different picture. So let me pull it up here for everyone in the back so you can see this. So now you don't see this rate of growth like we were looking at before. Now it starts to look like everything is staying flat. What the heck is going on? So now the USA has only had 139% returns. India's had 92% returns. But down in the bottom down here, Canada has had a negative 6% return. They've lost 6%. In Europe, they've lost 10%. In Hong Kong, lost 27%. And China has lost 31% when you adjust the measuring stick, the US dollar amount. Does that make sense? Because the US dollar is losing value, it's buying less and less goods. So even though your returns have gone up in US dollars terms, those US dollars buy less. So really, you have lost 30% of your purchasing power since 2009 in Hong Kong and China, and you have gained 139% in the USA. Starting to make sense? We have to look at the correct data. Now let's keep going. Now, we also want to look at the market weighted share. And so we have different sizes of index. So since 2018, we can look at the proportional sizes of these different indexes, and we can look at the weight of each one. And so each one of these currencies have a different weight of the overall economy of the world. And so of course we can see that the United States dollar, which is the reserve currency of the world, has the majority of that basket. And so this is in like the IMF shares of the basket. And so we can see how much the US dollar matters as the reserve currency of the world, which is why of course we're still measuring in dollars. But again, if the measuring tape is changing all the time, how can we get an accurate measure? We can't. Think about it like a table, and I'm trying to measure a table with a measuring tape. Now, if that measuring tape is changing all the time, am I really measuring the table, or am I measuring the measuring tape? Does that make sense? If the table's staying constant, but my tape measure is changing, I'm really measuring the tape. And that's what's happening with the dollar. The dollar supply is constantly changing all the time. So now, let's keep going. So now if we take all these indexes and we put them into a single line, so we take 80% of the global indexes and we just put them all together. We use that market weighted for size that I just showed you on the previous chart. All right. and they're weighted in the global economy in USD. Now we can see that we have gone up, and it's up 171%. So now we have the global indexes weighted per their size that we just showed you, and we're up 171%, okay? But now let's adjust it for the dollar, for the changing measuring stick. It's like using a measuring stick that's made out of a bungee cord. I mean, how well is that going to work? So now we have the consolidated global chart adjusted for their weight, and then we adjust it for the money supply, and we start to see a much different picture. Let me make it bigger for you guys. So now what you can see is that if we adjust it for the money supply, since 2009, here's where we're at. Remember, before it looked like this, and now it's starting to look like that. So while you think you're sitting on all-time highs in your stock market portfolios, are you really? When you adjust it for the dollars, we can see that after debasement, after devaluing, after making your dollars worth less, you actually haven't made any money. Since 2009, you've made 6%. Now, that shouldn't become as a surprise, because as you've heard your financial advisor telling you over and over and over that, you know, the market over the last 60, 80 years, you average a 6 to 8% return. So should you have been expecting anything better? Not if you're using real data. That's the question. All right. Now, the one thing that we have to keep in mind is, like I said, these prices keep on changing. Why? Well, because of the central banks. The central banks are the ones that continue to print the money supply. They're the ones that continue to change the measuring stick. They continue to pump money into the markets to keep them propped up. It's a Ponzi scheme, right? They have to keep putting money in, otherwise the whole system collapses. And the problem with a Ponzi scheme is you can't taper it. As soon as you stop putting money in, the people at the bottom don't get paid. And so they have to keep pumping to keep the markets up, and they have to keep manipulating the money supply to do that, which is why we looked at that M2 chart and it looked like a hockey stick. The problem is that this is completely wiping out the middle class, and it's adding massive amounts of systematic risk. So if we take a look at this chart, we can see what's happened. So this is price changes since January 1988 to December 2018. And this is a select consumer goods and services. Why consumer goods and services? Because wealth is not money. People think that if the government just prints a lot more currency and sends it out to everybody, everybody would be more wealthy. But that's not true. Wealth is goods and services. If we were both on a stranded on a deserted island and we had $1 billion of cash and maybe $1 billion of gold, would we be wealthy? Well, not if we had nothing to spend the money on. If we had no boat or no phone or no food or no water, we wouldn't be wealthy. They would be worth nothing. And so wealth is goods and services. The money, the currency, measures how much goods and services we can buy. So we need to look at the goods and services. And so since from 1998 to 2018, what we can see is that hospital services, your healthcare, has gotten way more expensive. We can see that college textbooks, way more expensive. College tuition, look at this, way more expensive, 200% increase. We can see childcare and medical care services. Those are important if you want to work. Average hourly wages have gone up a little bit, housing's gone up a little bit, food and beverage has gone up a little bit. So the cost of goods and services have gone up. Now some things have gone down, don't get me wrong. Cars have stayed flat. Clothing and furnishings have stayed flat. Okay, so not really inflation there. And then we have cell phones, computers, and TVs have actually gotten way more affordable. Why do you think TVs and computers and cell phones have gotten cheaper while medical care and education has gotten more expensive? Well, it probably has something to do with the amount of government involvement. These are free markets, with competitors competing against each other to make a better product, provide better service at a better price. The government's taken over healthcare and the government's taken over education. So you can see the discrepancy. The problem is for the average person, the middle class and the lower middle class, they don't have the assets that have gone up. And because their wages have stayed flat, it gets harder and harder and harder for you to live. Now, what are we going to expect from this? Now that you understand how to look at this data, all right, basically take the M2 money supply, subtract it from the gain so you can get an idea of what your real returns are minus debasement. We know that, as I said, they can't taper a Ponzi. We know that they are going to continue to pump the markets full of money. And so the first thing we're going to expect is lots of volatility, all right? Lots of volatility. That means that nothing goes up in a straight line. All right, so I have a chart here. This is in Germany, so the most famous case of hyperinflation, of course, we've seen it in Venezuela and Zimbabwe, et cetera. But Germany, the hyperinflation in Germany is one of the great cases of hyperinflation. We can see from about 1918 here to 1923, so over a 5-year period, Germany saw the most insane, the most extreme case of hyperinflation ever. And while this looks like it went up in a straight line, you're like, well, shoot, if I would have just sold my German marks for gold at that time, I would have crushed it, right? I would have gotten so rich. Well, the problem is when you look at that chart, you don't see all the volatility that's in there. So let me show you what I'm talking about. Here is a chart of the volatility during that time period. So this is the gold price in Weimar marks and the percentage change in gold price. And so what happens is, while it looks like it was a straight line, what we really had was all this volatility happening. Okay, and the reason why this is important to understand is because I've been calling gold the trade of the decade. I believe that Bitcoin can get to $1 million per coin. I believe that uranium and energy is going to have massive gains over the next couple of years because of the fundamental, because of the narrative that's happening. Just like here, you could have guessed that gold was going to go up in value because of the rate they were debasing the German mark. The problem is when you're living through it on a day-to-day basis and you're looking at your portfolio on a weekly or a monthly basis, it looks like this. So you're like, oh my gosh, look how much money I made on my gold investments or my Bitcoin or my uranium or whatever it is. And then, oh my gosh, now I'm down so much. I'm down, I should sell, right? I lost 40%. And then all of a sudden it goes back up and then it goes back down and it goes up and it goes down and it goes up and it goes down. So at any given time, you're up huge and then you're down huge and you lost money. And so we're seeing this happening in real time today. I hear from you guys all the time, like, I bought gold 3 months ago and now it's down. Yeah, nothing goes up, nothing goes down in a straight line either. All right, so you have to understand that in a time like this where we have the central banks pumping the markets full of fiat currency and we're going through this deleveraging cycle, they're fighting to pump it, to leverage it back up, the system's trying to deleverage back down. We're going to go through massive periods of volatility like this. The way that we live through this is to zoom out. Understand what are the underlying mechanisms that are causing this to happen. And if you understand what's happening, like what's happening in Weimar Republic Germany, they were paying people not to work, paying people not to produce, printing unlimited amounts of money. What do you think is going to happen? But you have to understand that so that you can have the stomach, you can have the strongs to live through this volatility. Because the one thing that we know is going to happen next year is it's going to continue to be volatile. We also know the central banks are going to continue to print money. We also know that that means more debasement. We also know that means that asset prices will continue to go higher. Now, not every day, not every week, not every month. If you're looking at your portfolio on a daily, weekly, monthly basis, you're never going to make it. Unless you're a day trader, and you'll still probably never make it. Again, this video was put together by Preston Pish. I took his slides. Follow him on Twitter at Preston Pish. And this is just an outlook of what we're looking at next year. Now, if you want to get into the nitty-gritty of what asset classes do I think are going to be the best, the energy, the monetary supply, et cetera, real estate, et cetera. If you want to know what I think are going to be the best, and most importantly, what we need to do this year to finish up, but more importantly, set that foundation for next year. Join me. I'm doing a special presentation next week. I'm going to go through it, show you what I'm doing. I have a workbook that you can download. You're going to be filling it out as we go together so you can get your game plan together. Of course, I'll go into question and answer, answer all your questions live while we're on there. There's a link down below if you'd like to join me. Other than that, what do you think about this? Do you think it's going to be volatile? Do you think it will continue going up? Do you think that the Feds will continue to print money? Give me a yes or a no down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't like the video, that's okay. Give me a thumbs down, even though YouTube took it away and I can't see your thumbs down. You can still voice your opinion. Leave me a comment. Let me know what you think. Other than that, that's what I got for you today. To your success. I'm out.